Hi there. My name is George Dagnino. I'm the editor of and publisher of the Peter Deck Portfolio Strategy and Management. What this video is about is why all the best economists, macro strategists, and that includes myself, have been wrong on the bond market in 2022. The bond market was a disaster. And I mean, macro strategies of companies managing multi-billion dollars, they all were bullish, including, as I said, including myself. So that was totally, it was one chance. And I mean, over the last 200 years, we never had a case like that. And I'll show you why. So what I did is, okay, George, you got to put things together. You got to find out what is the indicator, not words or ideas or suggestions, or maybe and maybe not. What are the indicators that could have told you to be careful and not to be wrong? It's painful to be wrong. I don't like to be wrong. Anyway, so this is what this presentation, I'm going to show you a few charts and explain why people have been wrong and what to look for in the future so that one can predict the bond market a little more safely. Okay, here we go. Okay, this is the business cycle, the way I computed from market data. It's not, there's no economic data in here, it's strictly the market. What is the market telling me about the business cycle, the strength or weakness of the economy? And this is a chart that goes back roughly 220 years. So, and what you see here, the economy is strengthening, the economy is weakening, the economy is strengthening, the economy is weakening, strengthening and weakening, and so on. Why do we care? Because during this time, and I wrote articles about, you will find in my website and on Seeking Alpha, that when this happens, usually what you have is cyclical stocks, so industrial materials, financials, anything related to commodities are outperforming the market. During this time, the economy slows down, earnings slow down, people start talking possibly about recession, and the outperformance, the stocks and the sectors outperforming the market are staples, utilities, healthcare, and bonds, and bonds. Because towards the end, usually the economy has a big decline and bonds really shine. During this period, by the way, the technology stocks I found that have behaved better here, but they're still okay during this period, but not as strong as in this period here. So this is the 2022. This is the line, the year that created why I've been wrong. So what happens here? The economy strengthened in 2020 after the COVID, and you have cyclicals, everything booming, money being ways thrown at people and so on. But sometimes in 2021, this indicator said, George, the economy now is going to slow down. And this is, by the way, is when you have the stock market peak. So everything is fine. So the economy is slowing down, so you have defensive sectors outperforming. But then here it says, okay, everything is fine. In this period, bonds should be very strong, as they were here, I mean, for 200 years. So this is the period, the tricky period of 2022. Then towards the end of 22, as I showed in my other videos, there was a rebound in some liquidity measures rebounded, the stock market rebounded, and now it seems like the business cycles is tired. But I'm not going to talk about this. My concern is why, despite the economy weakening, the bond market took a beating, and a serious one at that. Okay, what I've done, I've reproduced the same chart that I showed you before because I wanted to give you some perspective. But this one is the last 5 years. And as you can see, as I said, in 2020, the economy strengthened. 21, the economy started weakening. The stock market bottomed. Peaked. Then the economy started slowing down. The bond market strengthened. Then here the bond market weakened. So according to the book. But during this period, the bond market kept on weakening. Instead, should have been strengthening, because during weak economic times, the bond prices rise. So let's see what happens now in this period. 2 or 3 indicators that I think are reliable enough so that I'm not going to make the same mistakes I made in 2022. Okay, here is the business cycles, the same graph I showed you before. This is TLT, which is the price of long-term treasuries, 20 years or longer. So this is a price. So, and what you see is exactly what history shows. When the economy slows down, like in this period, the bond market is strong. Then the economy strengthens and the bond market goes down. So here the bond market, the economy weakens and the stock market and the bond market strengthens. Here now the economy strengthened again, and the bond prices start not doing anything. Now, what is the problem? The problem in 2022 of all this market strategies that they saw the economy slowing down, but bond prices declined. They should have risen like they did here in this period here. So this is now, I'm going to zero in 2 or 3 indicators in this period. That's what has been the problem of 2022. Painful problem. Okay, this is the business cycle. The economy weakening, the economy strengthening, the economy weakening, and the economy strengthening from the fall of 2022. But again, we concentrate on 2022. And this curve below is the pattern of the CRB, the index commodity index. And then commodities, when the economy weakens, commodities decline. When the economy strengthens, the commodities also strengthen. So it's a good indicator to gauge the strength of the economy. Now, the first warning is exactly in 2022 came from the commodity market. Why? Because here the economy weakened, but commodities did not go down as in this period here. They kept on really rising. That should have been a warning. Economy weakening, and this instead is going up. It should be the other way around. So the message was something was wrong someplace. They had to look into it. So that was the first warning that 2022 was going to be an abnormal year. So let's see what else is there. So this is the business cycle indicator, and this is the 2-year treasury yields, the interest rates on 2-year treasuries. Now, 2-year treasuries behave exactly for the last 200 years like commodities, exactly to the same turning points. In fact, the economy is weakening, short-term interest rates decline. Forget about the Fed. I have another video that forget about the Fed, watch the markets. Then what happens, the economy strengthened and yields stopped declining. Now, this is what something was different in 2022, which you never had. The economy weakening, and instead the 2-year yields, started going up way ahead of the Fed, by the way, a year and a half ahead of the Fed. So they started going up. So that was a sign that this business cycle was totally different from the other. So you got to keep an eye on this one. This was a big miss. So here the economy in the fall of 2022 bottomed, the stock market bottomed, everything went up, and sure enough, yields picked up again. Now, what I'm watching carefully is this turn, because this may be telling that the economy is weakening. Now, if the economy is weakening, I think things will go back to the norm. In other words, when the economy weakens, interest rates decline. And it looks like it's beginning to, but that's not the subject of this video anyway. The bottom line is this should have been a warning that in 2022 was an abnormal year, because what you see, an economy weakening and short-term rate rising. It never happens that way, but it happened in 2022. So that should have been for bond investor, be careful. Something is different. You got to look into it very carefully. And that's the thing. The next chart shows what I think could be, give me a hint of what really happened. And this is the chart that confirms the message of short-term interest rates, and plus adds another interesting, I think, dimension. Again, this is spreads. Sorry, this is the business cycle. The economy weakening, strengthening, weakening. This is 2022, and this is the economy strengthening again, and this possible downturn. The chart below is the ratio between high yield bonds and TLT. So when the chart goes down, is when the economy slows down, what you see is TLT stronger than high yield bonds. And that is logical, because when things go down, you sell junk bonds and you look for safety in treasuries. And that's why the ratio declines. And that's the way it should be. When the economy strengthens, of course, there is more earnings, there is more liquidity in the system, the economy is strong. The junk bonds is not at risk of, there is less risk of default. Therefore, what you see, the high yield bond market stronger than the treasury bonds, because people sell treasuries and go into the bond market. Because the bond market, even if it is riskier, they provide a higher yield and so on. By the way, you should invest in bonds in this period because bond prices decline. Now, what happened in 2022? In 2022, what this curve is saying, that the high yield bond market is stronger than the treasury bond market. This is incredible. Why? Because in a recession, people should avoid junk bonds and buy treasuries. Instead, in 2022, it did not happen. So the question is why? And by the way, I mentioned this in some videos that I have for a year ago, or no, several months ago. Why the junk bond market behaved better than TLT? Because there was a lot of money. Because in the economy, there was so much money that investors said, look, what is the danger to invest in the junk bond market? You get a higher yield, forget about treasuries. So the strength in this indicator tells you that there is a lot of liquidity. And when there is a lot of liquidity, usually the economy there is an underlying strength in the economy, and the bond market does not like that. And this is the only indicator, together with the commodities, that was rising, telling you that the economy was stronger than what you saw here, and therefore you should be careful in investing in treasury bonds. What is happening now in 2023? This curve is going up. And that's why the bond market still is not doing much. The TLT I'm talking about, the treasuries. Because there is still too much liquidity. There is too much underlying strength in the economy. Of course, the answer, we know where all this liquidity comes from. And again, I said this way, was one of the first on mentioning this months and months ago. It comes from government spending, the huge government spending, the huge programs that they have been approved for 2023. So, and this is why this curve is rising, saying that forget about treasury, a high yield is stronger. However, so this is an indicator that I watch like a hog hawk together with the commodities. But what you see now is the economy may be slowing down. And interesting enough, this is also rolling over. What does it mean? It means that maybe, and I like this idea, by the way, that maybe this year was the exception. But now we are going, the next few years, we are going back to the rule that it was always like this for the last several decades, that when the economy slows down, the treasuries are stronger than their yield, than the high yield bonds. And if this continues to go down, my guess is this goes down and commodities weaken, as we saw, then the bond market, the treasuries could become attractive again. But this is still not a trend that is well established. So this is what I'm watching for. These are the publications that I have, the Peter Dack portfolio. You can get an issue free here by going to this website. I wrote this book, was commissioned by McGraw-Hill Education, has been sold in all around the world, in Asia, in several languages in Asia. 2 more books, and I have on my YouTube channel. By the way, if you could subscribe after you see this video, I would really appreciate it. It helps me establishing myself. Thank you very much. Well, thank you very much for reviewing this video. I hope you find that useful. It took me a while to figure out what are the indicators that I should follow to make sure that I don't make the same mistakes I made in 2020. So right now the message is be careful. Let the indicators tell you what's going on. It looks like we are going towards a strong bond market, but the trends, they're not there yet. I think the high yield market is still too strong, saying that basically there's still too much liquidity, meaning there is too much strength in the economy for bonds really for yields to decline and bond prices to rise. So we'll have to wait a little bit. Okay, thank you very much. See you soon, I hope. Take care. Bye-bye.